As the markets keep falling this year, what's resulted is a lot of my favorite high-yielding dividend stocks now offering even higher yields. Just as one example, a very pleasant sight for me was seeing Carey experience a really sizable drop recently. As someone looking to load up on more WPC, I mentioned several months ago that I had been waiting for the price of this stock to go down because it had still been performing really well this year. I also thought it was overvalued when I looked over their balance sheet, so when I saw the price drop about 15% in 2 weeks, it made me really happy enough to pick up some more shares this week. As of the making of this video, this near dividend aristocrat stock now yields 5.76%. Even more dramatic has been the drop of Realty Income, which over the last month has fallen more than 20%. Despite it being my largest holding, it didn't make me nervous at all to see this price drop, because first of all, I invest for dividends, not share price performance. If Realty Income was a stock I relied on for growth, like maybe a Tesla kind of company, then yeah, I'd be really concerned. But because I invest for income, seeing dramatic share prices fall like what just happened doesn't concern me one bit. Secondly, Realty Income's been providing evidence that this monthly dividend it pays isn't anywhere close to being cut. Their stock's a dividend aristocrat, and they haven't cut it since being publicly listed back in 1994 on the New York Stock Exchange. Thirdly, opportunities like these are perfect for buying more shares at a discounted price. A $1,000 investment today in Realty Income will buy you almost an additional 3 shares. That means more monthly income than you would have received investing last month. And I know 3 shares may not sound like much, but this was a $70 stock just a month ago. But maybe even better is that virtually every stock in my portfolio that was yielding over 8% are now selling at even larger discounts. What's resulted is many of these stocks now currently offering yields of over 11%, if not more, during our current market conditions. So in today's video, I want to present some of my favorite high-yielding stocks that I own that have seen their yields skyrocket even higher this year. While it is true that the following stocks are riskier than average because of their higher yields, because I still own all of these stocks, it's my belief that none of these companies are in any real danger anytime soon. At least based upon all the research that I've done. Of course, anything can change in the months ahead, so as I always like to say, be sure to perform your own research and due diligence before making any investment. You should always make sure that you have a clear understanding of what you're investing in and how it earns revenue in order to sustain their dividends. So with that being said, let's go ahead and get started. The first stock we're going to look at today is Pennant Park Floating Rate Capital, ticker symbol PFLT. They're a business development company that seeks to make secondary direct, debt, equity, and loan investments. They seek to invest through floating rate loans in private or thinly traded public middle market companies. It primarily invests in the United States and to a limited extent non-US companies. The fund typically invests between $2 million and $20 million into each business. Additionally, they invest in equity securities such as preferred stock, common stock, warrants, or options. They typically provide first lien debt to companies with strong cash flow, growth potential, and viable exit strategies. Currently offering an 11.66% dividend yield to shareholders, Penn Park now trades for $9.78 per share. Right now it pays a monthly dividend of 9.5 cents per share every month, and in fact that's what the stock has almost always paid since its inception back in 2011. The last time this stock grew its dividend was back in 2015, so if you're looking for growth, you're not going to experience it here unless you choose to reinvest your dividends. But at over an 11% dividend yield and having never cut their dividend, this is an option worth considering for people seeking high income today or for people who want to create a large dividend snowball through reinvesting. The reason why Penn and Park hasn't grown their dividend like other BDCs such as Main Street Capital is because they pursue a different strategy. While other business development companies go after higher growth companies, Penn and Park likes to focus more on capital preservation and they invest in companies that they believe in are generally lower risk. So while this stock isn't a growth machine, it is a BDC that likes to focus more on stability. On their website, they like to tout that they've provided investors with a steady and stable dividend income stream since their inception back in 2011. So if a high yield with an emphasis on stability sounds appealing, then Penn Park, in my opinion, might be a really good option worth considering. As you notice, this company has the word floating in their name. That's because PFLT only issues floating rate loans. This means that when interest rates are high, Penn Park will actually earn more revenue from their loans. At the same time, though, it can increase the default risk since clients are now having to pay more for their loans. That's where a good management team comes in handy, which Penn Park has been able to do a good job managing their debt portfolio up to this point. Looking at their portfolio, we can see it's comprised of a lot of different industries, with services being the largest sector right now. They currently have 123 companies in their portfolio, and 87% of their debt is made up of first lien loans. First lien loans get priority when it comes to repayment. In case the company Penn Park invests in goes bankrupt, first lien debt holders are first in line to receive anything left from liquidating the remaining assets. Even if a company does go bankrupt, it's extremely rare that the loan would be a total loss for the company. There's almost always something left that would allow Penn Park to recoup a part of their loan. Ultimately, only time will tell if this company will be able to maintain its dividend, depending on how bad the economy gets. but so far everything still appears safe for the time being. Up next, we're going to take a look at TriplePoint Venture Growth, ticker symbol Tpvg. This is another business development company that specializes in making investments in venture capital-backed companies at their growth stage. Having been founded back in 2013, the company provides debt financing to venture growth space companies, which includes growth capital loans, secured and customized loans, equipment financing, and direct equity investments. They're externally managed by their sponsor, TriplePoint Capital, who've been in business since 2006, and they're headquartered in Menlo Park, California. Tpvg is one stock I own that's gotten beaten up quite a bit this year compared to other BDCs. As of today, the share price of Tpvg is down by almost a third for the year. But right now it currently offers a dividend yield of 12.16% to shareholders. It pays quarterly dividends unlike Penn and Park at a rate of 36 cents per share. Although this stock has only been around since 2014, they've never cut their dividend in their history. But they also haven't increased their dividend since 2015, just like with PFLT. So just like with Pennant Park, this is a stock that's good for income but not growth. But over the long term, Tpvg has remained relatively flat just like the previous stock. But again, as I mentioned, they have taken a huge beating this year. TriplePoint Venture Growth is not like most BDCs that we've seen in that they are different in a couple of ways. They exclusively like to focus on technology, life sciences, and other high-growth industries, which is similar to some BDCs we've seen in the past, like Hercules Capital, for example. But TriplePoint also only lends to companies that are venture capital backed and during their venture growth stage. It's a very specific period during a company's startup process when a company has already proven themselves to have achieved a sizable amount of success and they're seeking additional funding in order to further expand their business. Other BDCs out there will lend money at other stages during a company's growth, or they'll provide financing to help rescue a company out of a dire situation through restructuring. But TriplePoint doesn't assist in any of those kinds of businesses. So in a way, this does provide more protection since in order for TriplePoint to consider offering a business financing, they would have had to have provided a lot of proof that they've already been pretty successful. You can see over the years that this BDC has provided financing to a lot of really popular companies. TriplePoint's had a lot of success providing financing to businesses like Facebook, Square, Beyond Meat, Etsy, and a whole lot of other really recognizable businesses. Based on what I've looked at for this company, everything seems healthy in terms of that dividend. There was an article that came out in July that discussed how venture capital firms are making fewer investments this year when compared to 2021. As a result, this has actually increased the demand for venture debt services, which is what TriplePoint Venture Growth provides. Remember, this BDC only invests in venture-backed startups, so if venture capital companies are investing less money this year, that should increase the demand for TriplePoint. This would result in a much more competitive market, and Tpvg will have a larger pool of more eligible borrowers. So with all things considered, I'm still really optimistic about this company's future. This next stock is one that I consider to be one of my riskiest holdings, so I wanted to make that clear before continuing. But the third company on this list is Ready Capital, ticker symbol RC. Ready Capital, with their subsidiaries, operates as a real estate finance company in the United States. The company originates, acquires, finances, and services small business commercial loans and small business administration loans. To a lesser extent, they're also invested in mortgage-backed securities collateralized primarily by SBC loans and residential mortgage loans. RC is the highest yielding dividend stock in this video at 15.6%. It pays quarterly dividends, with their last being for 42 cents per share. Over the last 5 years, their stock has gone through a couple dividend cuts, which is typically a big red flag for me. But this was all caused by the COVID pandemic, and as you can see, it was only a temporary situation. Their stock's dividend fully recovered, and it's even grown higher than before the pandemic. Just like with all the other companies we've looked at, RC's share price has remained constant, not growing much over the years. But because I like to invest for income, I'm totally fine with that if there's a super high dividend being paid out. Ready Capital is a mortgage REIT, and if you've seen my channel before, you're probably well aware that I'm not the biggest fan of mortgage REITs. Despite the fact that I love high-yielding dividend stocks and nearly all M-REITs offer yields upwards of 8% or higher, the majority of these companies simply have very mediocre or even terrible track records. Some of the largest and most well-known companies in this sector have a long history of declining share prices as well as dividend cuts. And in a high interest rate environment, given how these companies are structured, most tend to do pretty poorly in these conditions. But RC Capital does stand apart from your typical mortgage REIT like Annaly Capital. They actually do something that hardly any other M-REITs out there do. Their largest revenue source isn't investing in mortgage-backed securities, it's actually originating SBC loans, which are secured by stabilized investor properties. 99% of these loans are senior secured, meaning that if the borrower goes bankrupt, RC Capital is first in line to collect whatever assets are left after liquidation. A large portion of these loans are actually bridge loans, which is something that another M-REIT I like, Arbor Realty, specializes in. A bridge loan is a super short-term loan, sometimes as short as 2 weeks, that a borrower takes out in order to find longer-term financing options. These types of loans are typically much safer investments because they're very short, and the whole reason why a landlord or a company takes out a bridge loan is because they plan on borrowing for a longer period of time with another provider. Obviously, a company would have to be pretty confident in what they're doing in order to take out a bridge loan in the first place. Because if they fail, they obviously won't be able to find a longer-term lender for their project. There's a lot of other things that I like about this company as well. Specifically, they've been expanding like crazy over the last few years by merging and acquiring new companies that have helped expand their product line. We'll have to see how this stock plays out going forward, but they just announced another dividend payment about 2 weeks ago for the same amount as last quarter. So these are just some of the high-yielding stocks in my portfolio that are still selling at a big discount. But like I mentioned, we don't know if stocks are going to continue to fall or if the bottom is actually right upon us. It's my personal belief that we're not quite ready to recover yet from this downturn. But still, I'm choosing to remain invested in all of these stocks, and I'm not seeing anything up to this point that would indicate that any of these companies are in danger of cutting their dividend anytime soon. But again, just be sure to perform your own research and come to your own conclusion before making any kind of investment decision.